So if you like saving money on taxes, you probably already know how you can hire your child through your business, have that be a deduction to the business, and at the same time tax-free income to the child, as long as your business is structured correctly and you pay them under the filing limit, which in 2025 is $15,000, right? But what I want to really go into in today's video is how to maximize this strategy both for yourself and especially for your child or children, so that having taught them the value of hard work and financial good sense, you can see, especially if you stick around to the end, how in a little case study we're going to do, this can amount to potentially millions of dollars by the time that they're ready to retire. Hi, I'm John Norbert and welcome to the Financial Prof series. Alright, so let's go through 3 big tips about how you can truly maximize the hiring your children tax strategy, right? Alright, so tip number 1, once you hire them and you've made sure that everything's set up correctly, you're not going to pay them over the filing limit, keep it simple for them and for yourself, and that it's doing proper duties that are appropriate to the age of the child, etc. Then if you don't know that, by the way, we just released a video here this past week you can go back and watch about how to hire your children here in 2025. What we're going to dive into is these 3 big tips of what to do once you have hired your child to really maximize this benefit, right? So, step number 1, make sure that when you hire them, you have them contribute to a Roth 401k. Now, if you're paying them $15,000, great news. Not only is that under the filing limit, that's also under the maximum amount that you can contribute to a 401k here in 2025. So, obviously they could contribute that whole $15,000 amount, or you could on their behalf, to a Roth 401k, right? Okay, now here's the second tip. You can also match that amount, and thanks to Secure 2.0, it is now possible here in 2025 to match that amount as Roth, meaning that the child's contribution goes in $15,000 post-tax, Roth, all that good stuff, and the employer match, that is your business's match that you get to write off, by the way, goes in also as a Roth contribution from the business. If you take $15,000 times 4%, that's $600, right? So at this point, we're talking about $15,600. Why 4%? Because for most businesses, this is about where they end up if they don't have a profit sharing plan in terms of having a safe harbor 401k. Obviously, if you have a profit sharing plan and you decide to really boost that thing, this match can become even bigger. In other words, maximizing that benefit even further potentially. But for all intents and purposes, we're assuming a 4% employer match to that 401k, $600 plus $15,000, right? 15.6k. All Roth. Now, tip number 3, you can also use that same income, even if you contribute it all to a Roth 401k, to count towards the earned income that the child would need to contribute to a Roth IRA. So that third tip, then take that and contribute the max to a Roth IRA, which here in 2025, a Roth IRA, you can contribute up to $7,000 if you're under the age of 50, which if they're your child, we're probably talking about being under the age of 50. We talked a little bit in previous videos about how for the IRS's purposes, usually around age 7 is where you're not going to get any guff from that audit agent in terms of is the child too young from a legal basis. You can do it earlier like we talked about, but it generally is kind of a safe rule of thumb that age 7 is where you can start hiring your children and not have to worry about any kind of rough feedback if you were to face an audit, right? Okay, so let's say you're doing those 3 things, right? Obviously you've hired your child, right? You're contributing to a Roth 401k on their behalf, you're matching it, and that match is going in as Roth, and you're contributing to a Roth IRA on top of that. At the end of the day, we're talking about 22.6k going into Roth accounts for this child, which is fantastic because that's where, we have our most tax advantage money in terms of true retirement accounts. So let's do a little case study, right? Let's say we have 22.6k between that Roth 401k, Roth IRA, and Roth match, and contribute it in the year that the child turns 7. And then let's say that the child continues to work for your business and does so for the next 10 years. So we're talking about a total of 11 contributions, right? Right up until they're getting ready to turn 18, right? Now, assuming a potential 7% annualized growth rate, you could be looking at a total of over $350,000 by the time that they're getting ready to enter into adulthood in Roth accounts, right? All of that completely Roth. So the actual amount is $356,709.34 over 11 periods for for a 22.6K contribution, right? That's the initial contribution plus 10 more years. That's fantastic. Imagine entering into adulthood with an account set up for you that you can use for basically, obviously, retirement, but you could also take out that full contribution amount, not the growth, just the contribution, and use it to potentially fund a business venture of the child's, for instance. They could take it out and start their own business. They could take out up to the contributions that they put in and decide to buy a piece of real estate. Oh, and by the way, if it's a first-time home purchase for that child, they can actually take out $10,000 regardless of contributions and growth and put that towards that first-time home purchase because it's in a Roth IRA, right? But let's say that they left it in there, right? You've taught them the value of hard work, good financial sense, and imparted many lessons along the way. Maybe they're even at this point, the heir apparent to the business. And they're continuing to contribute that amount, right? So let's just stop right here and fast forward 45 years. They're 17, fast forward 45 years, that takes us to age 62. Let's say what happens if they don't contribute another penny. All right, you start out with $356,709.34 in Roth accounts, stopped contributing at age 18, that is after 11 years, and then at age 17 after 11 years, never contributed another penny. By the time they reach age 62, which right now is the legal early claim limit for Social Security, in other words, that's the earliest that you can claim social, you would be looking at potentially $7,491,770.71, assuming that same annualized 7% growth rate, right? That's the potential amount you could have at the end of that period when your child is now turning 62 and probably getting ready to retire. That's a fantastic amount. And again, because it's all in Roth, it's all able to come out tax-free. Wonderful. But let's take it even a step further, right? Again, let's say you really instilled those lessons of financial know-how and good habits into your child, and not only did they contribute all the way up until they entered into adulthood, but they contributed until they turned 62. So you start out with an initial contribution of $22,600 the year that you hire them, and then another 55 years, right? Again, getting us to that age 62 range. Once you do that, assuming that same 7% rate of growth, if that child continued to contribute $22,600 every year for 55 more years, then you could potentially, or rather your child could potentially, be looking at a total of $13,949,705.23. This is fantastic, because this is where generational wealth really starts to get built. And again, obviously that's only if they contributed that exact same amount and never went up. If, as most people, their income rose over the coming decades and they decided to start contributing more, that almost $14 million could obviously become much, much more than that. And in future years, Roth contribution limits will probably rise as well, meaning that not only could they potentially have 13.9 million, almost 14 million in Roth accounts, but if they did, again, raise their contribution in future years, they could be looking at literally tens of millions of potential dollars, depending on investment returns and, other factors as well, right? In tax-free income that they could take out in their retirement. Fantastic, amazing. It really goes to show you what the time value of money coupled with good habits can do. So if you're thinking about hiring your child in your business, or maybe you've already done so, but you're wondering, am I really maximizing this strategy? And you'd like to talk to somebody, maybe bounce a few ideas off of us, drop us a line or give us a call. And in the meantime, like and subscribe so you never miss another video from our series. And in the meantime, I'll see you out.